Hello everyone, welcome to Akira's Academy of Accounting and Finance, and I hope you did practice of what we studied previously relating to the second chapter, and today we are going to revise whatever we studied. Okay, so this is going to be a revision session. Right now, what is second chapter? It's about the reconstitution of a partnership firm. The firm is going to reconstitute. The firm enters into an agreement. Okay, whenever the firm is formed, partnership firm, they enters into an agreement. When they enter into an agreement, everything is mentioned. What will be the profit sharing ratio, how many assets they will bring, how much is the liability, how they will share each and everything. If there is a dispute, what will happen, how they will adjust to all these things as mentioned in the old deed. Right now, a new partner enters into the business. So when a new partner enters into the business, everything will change. We need to mention the name and address, the profit sharing ratio, everything we need to mention in the old ratio. Now everything will get changed. So what we need to form? We need to form a new agreement. So that is a reconstitution of a partnership firm. So when a new we need to reconstitute, we need to do certain things, okay, that you have to do in your you have to do, whether you enters into a partnership firm or not, but you have to understand all these things maybe in future. So when a new partner admits into the business, we need to find out the new profit sharing ratio. Earlier there were, let's say, two partners sharing profit among each other equally. Now enters a new partner they are giving a certain share of profit. So they need to find out how much profit they will receive, and they will get to know their new profit sharing ratio of all the three partners. So there could be a situation wherein it will be given they are sharing this much amount of profit, so the remaining profit belongs to the old partners, and they will share, they will determine how much is the new ratio. Or else it could be given that they are sacrificing their part. So whatever is the part they are sacrificing, they are already having a ratio. Out of that, they are sacrificing its part. So whatever is the remaining is their new ratio, and the sacrificed part is the new partner's ratio. Or there could be a situation wherein only one partner is sacrificing. Okay, so whatever his part he is sacrificing, the new partner is going to receive. So that is how we will determine the new profit sharing ratio. Now, second point, we discussed about the sacrificing ratio. Sacrificing, there were certain old ratio, they were sharing profit and loss in a certain ratio. Now there is a new profit and loss sharing ratio because they are giving a part of profit, right? They determine the new profit and loss sharing ratio. So when we deduct old ratio, new ratio from old ratio, what we receive is the sacrificing ratio. How much the existing partners, this is about existing partners, okay, the old partners, or else I could mention the old partners, how much they have sacrificed. How they will determine? By deducting new ratio from the old ratio, they will get to know their sacrificing ratio. Why it is important? As we discussed, it is important for certain things, majorly for goodwill, right? So third point, we discussed about the valuation and adjustment of goodwill. What is goodwill? It is the name, the reputation, the business connection, the customer base, whatever the firm has earned over a period of time. Okay, that means if the, and because of that they are earning profit. Okay, when the are earning minimal profit or there is losses, the concept of goodwill won't arise in that situation. Goodwill means they are earning more than the normal profit, then the concept of goodwill arise. So what they will say to the new partner, like, we are sharing our profit, and in the future we are going to share the profit, and we have earned this much amount of goodwill in the market, so you need to bring your share of premium amount in the business. Okay, so first we need to determine the amount of goodwill. What is the goodwill of the firm? How we will determine? There were three methods. One was average method, second is super profit method, third is capitalization method. Average profit method, we will calculate the average profit of the past years, like how much profit we are, the firm is earning from the past 4 years or 5 years, and how much we find out the average, and how much they are going to receive in the future period, okay, for how many years. So we will multiply with that, we will get the goodwill amount. That is the simple average method. And in that average profit method, there was a weighted average profit. Like valuation, when we talk about, there are three methods: average profit, this average profit, simple average profit, and weighted average profit. What is weighted average profit? Weighted average profit means the current year profit is being given more importance, they have been given more weightage. Okay, so whatever past year profits they have received, it may be in increasing order or it may be in a decreasing order. So accordingly the weights being assigned to all the past years, and on that we will calculate the weighted average profit, and that weighted average profit will be the amount of the goodwill. Okay, for how many years they are expecting that profit they are going to receive. Second is super profit. What is super profit? There is, in the market there is capital. If we employ the capital, if we invest the amount, or if the firm is this much amount of capital the firm has invested, the partners have invested this much amount into the firm, the normal rate of return is how much on that? Okay, normal rate of return is how much, whatever capital they have invested on that, how much market rate is that, we will get the normal profit, we will receive the normal profit. And from that normal profit we will calculate first the average profit. What is the average profit actually of the firm, and what is the normal profit in the market? So from the average profit we will deduct normal profit, and what we will get? The super profit, and this super profit we are going to receive for how many years of purchase will be the value of goodwill. Okay, and the third is capitalization method. The average profit is capitalization of average profit or capitalization of super profit. Now in capitalization of average profit, what we do? We know the average profit, right? We know the average profit. This is the average profit. Okay, let's say 70,000 is the average profit, right? So in the market, if you invest 100 rupees, you get 10 rupees, right? Now you have received 70,000. So how much a person should have invested so that he could receive 70,000? That is 70 lakhs. Okay, 70 lakhs they should have invested, then only they could receive 70,000. But 7 lakhs, 7 lakhs, 10% of 7, if they invest 7 lakh, then only they will receive 10%, 70,000. But this is the capitalized amount. But what is they receive? What is the capital invested by the firm? We'll get to know through the net assets. How much is their net asset? How we will determine the net asset? Total assets minus third party liabilities. Total asset exclusive of goodwill, right? Any fictitious assets, third party liabilities. Okay, so we will get the net asset. This much should be the capital of the existing partners. But how much it is? It is 7 lakh. Let's say net asset is 6,50,000. 6,50,000. So how much is the amount of goodwill? Average 7 lakh minus 6,50,000, that is 50,000. Okay, this is the amount of goodwill we will determine by using capitalization of average profit. Similarly, we can find out through capitalization of super profit. Now let's say in the same situation we discuss, like capital 6,50,000 is the capital amount. Okay, 6,50,000 is the capital amount. How much return they are receiving? They are receiving 10%. 10% is 65,000. Now, how much is their average profit? How we will determine super profit? Average profit minus normal profit. Average profit is 70,000 minus 65,000. So 5,000 is the super profit. This super profit we will capitalize it. How? Into 100 by 10, that is 50,000, and this will be the amount of goodwill. Okay, this will be the amount of goodwill. So these are the three methods we discussed, how to calculate the goodwill. Then we discuss about how we will give the treatment of goodwill. Like this amount of goodwill, whatever is calculated, is the total goodwill of the firm. So when a new partner enters into the business, he will bring his share of goodwill. Okay, not the full amount. Okay, he will bring his share, 1,50,000, let's say 1/4 he brings his share of 1,50,000. So he shares 1/4 of the profit. He will bring the premium amount of goodwill as 1/4 only, and that premium amount of goodwill will be shared among the existing partners, the old partners, in their sacrificing ratio, because they are sacrificing their part of profit, and the new partner is going to receive that profit. So the new partner will, whatever goodwill amount he brings into the business, will be shared among the old partners in their sacrificing ratio. Now there could be a situation when we treatment of goodwill, when we talked about, there could be a situation that he settled the goodwill amount outside the business, so there will be no entry. Second situation, when he brings the goodwill amount into the business. Now if the partners want to retain that goodwill amount in the business, their capital account will be credited, and premium of goodwill account, the first entry would be he brings in the goodwill, so cash account debit to the new partner's capital account to premium of goodwill. And if they want to retain that goodwill amount, so the premium of goodwill account debit to the old partner's capital account in their sacrificing ratio. What if they want to withdraw that amount? So their capital account will debit it and cash will go out from the business. So partner's capital account debit to cash account. If they are partly withdrawing, so that much amount will be debited from their capital account and cash will be credited. Now what if he doesn't bring the goodwill into the business? The new partner, he is not having money, he is not bringing. What he will say? Adjust my goodwill amount from the future profit. How to adjust? We will open his current account. Okay, so we will open the new partner's current account. That account will be debited, and the premium amount will be distributed among the old partners in their sacrificing ratio. What will be the entry? B, let's say B's current account debit. B is a new partner, so B's current account debit to premium of goodwill account. Premium of goodwill account, we will close it to the new old partner's capital account. So when he brings in, cash comes into the business. When he doesn't brings in, the amount will be transferred to his current account. Okay, and then the future profit will be adjusted with his current account, right? Now there could be a hidden goodwill. Hidden goodwill means he brings in the capital, right? The new partner brings in the capital amount. So they try to determine the, if let's say he brings in 20,000 and he is sharing 1/4 of the profit, so how much should be the total capital of the business? It should be 80,000. But when they try to calculate, the profit comes, the capital employed comes to be 50,000, or let's say 60,000. So 20,000 is the goodwill amount. Okay, the capital should be 80,000, but the current, when they calculated the current capital amount, it comes to 60,000. So that means 20,000 is the goodwill amount, and of that goodwill amount, the new partner will bring his share, not the full amount, right? Now there could be a situation, there is goodwill already existing in the business. So if goodwill is existing in the business, they need to close that goodwill account, and that goodwill will be transferred to the partner's capital account. So partner's capital account will be debited to goodwill account. If goodwill exists in the business, there is already goodwill which is existing in the business, so the old partners will share that goodwill amount in their old profit sharing ratio, not as per the sacrificing ratio. Premium amount, sacrificing ratio, old amount in their old profit sharing ratio. Similar could be the case of distribution of accumulated profits. There are accumulated profit and loss, general reserves, profits and loss. That profit and loss will also be distributed among the old partners in their old profit sharing ratio. And what else we will do? We will do the revaluation of assets and reassessment of liabilities. We will prepare a revaluation account wherein if there is an increase or decrease in assets or liabilities, or if there is an unrecorded assets or unrecorded liabilities, we are going to show them in our books at the revised value, right? So whatever effect is there of assets and liabilities, for that we will prepare a revaluation account. So on that revaluation of assets and liabilities, there could be a gain or there could be a loss. When there is a gain or there is a loss, that gain or loss will be distributed among the old partners, okay, in their old profit sharing ratio. And in this, the last that we are going to discuss about is adjustment of capital. Adjustment of capital means the old partners say, okay, whatever is the new profit sharing ratio, that capital amount should be according to that only, right? So how they will get to know? They need to find out the new ratio. The old partners capital, the new partner capital, what the new partner have bring into the business, his share we know, okay. So what should be the total capital of the three partners, we'll get to know, okay. And on the basis of new profit sharing ratio, that should be the capital of each and every partner. What is the capital of the old partners? That old partners capital, let's say it is 30,000, 20,000 and 15,000. 15,000 is of new partner, okay, new partner. So the old partner should be 30,000 and 20,000 as per the new profit sharing ratio. How much it is? It is, let's say, 35,000 and his is 15,000, okay. This is their old capital. So what they will do? A will bring 5,000, okay, it should be 35,000, so A should bring 5,000 into the business. So cash comes into the business, cash account debit to A's capital account, and B should withdraw 5,000 because his capital is 20,000, his capital should be 15,000, so he will withdraw that amount. So B's capital account debit to cash account, cash goes out from the business. So that is what will be there in the admission of a new partner. And there is one thing that is in a reconstitution of partnership firm, when the partners, existing partners, decide to change their profit sharing ratio. So when they decide to change their profit sharing ratio, they again have to do all these things, okay. That is a new agreement they are forming, okay. Likewise, I discussed three partners are they are sharing equally 1:1:1. They change the profit sharing ratio in the ratio of 3:2:1. So in this case, some partner will be gaining, some partner will be sacrificing. So whosoever is sacrificing its part of profit is going to get the premium of goodwill amount, and who will give that goodwill amount? To the partner who is going to gain in the future the profit amount, okay. So that partner will give their share from their capital to the partner who is sacrificing. Similarly, we will revalue the assets and liabilities, we will distribute the accumulated profits, we will distribute the goodwill, existing goodwill, all these things in their old profit sharing ratio. Regarding goodwill, gaining ratio and sacrificing ratio, and then a new balance sheet will be formed as per the new profit sharing ratio. I hope you got all these things. The second chapter, I know there are varied topics, but for that, as I always say, you need to practice and practice. See you in the next video. Thank you very much.